Hey, what's up guys? John here. The CEO of Chase Bank, Jamie Dimon, which is one of the largest banks, he just came out and issued a warning of what seems to be an economic depression. He said in his own words that what we are about to do, we're going to be writing history books on for the next 50 years. He believes that we're going to be stepping into an economic hurricane. On this channel, talk about personal finance, real estate, business, and money. And I talk about the truth of what's really happening in the economy. And I have a lot of new subscribers, about 10,000 new subscribers last few weeks. So if you're new to the channel, welcome. What's happening right now is we're stepping into a whole new type of economy, a whole new type of leverage. And when I say leverage, I mean the access to capital, which is going to impact one's ability to borrow money, whether it be through personal loans, consumer loans, real estate loans, whether it be through hard money loans. All of these different loan products are going to be changing with the new risk in this economic environment, which I believe is going to pull back on hiring, and it's going to have a long-term global economic outlook that's going to be altered because of this. And so here's what's going on. Jamie Dimon says, brace yourself for an economic hurricane caused by the Fed and the Ukraine. So they are going to blame what's happening outside of America on the problems that are going to be coming into America. And I believe they're going to be doing that more and more and more over this upcoming issue. They're going to start to really point the finger at that to deflect responsibility on how things are truly handled over the last few years. He says, the CEO says he's preparing for the biggest bank for an economic hurricane on the horizon and advised investors to do the same. I said there's storm in the clouds, but I'm going to change it. It's a hurricane, Dimon said Wednesday at the financial conference in New York. While conditions seem fine at the moment, nobody knows if the hurricane is a minor one or a superstorm Sandy. You better brace yourself, Dimon told a room full of analysts and investors. JP Morgan is bracing ourselves, and we're going to be very conservative with our balance sheets. Beginning late last year, with high-flying tech name stocks have been hammered as investors prepare for the end of the Federal Reserve's cheap money era. Inflation and multi-decade highs, exacerbated by supply chain disruptions in the pandemic, has sown the fear that the Fed will inadvertently tip the economy into a recession as it combats price increases. While stocks bounce from a precipitous decline in recent weeks on optimism that inflation may be easing, Dimon seems to dash hopes that the bottom is in. Right now, it's kind of sunny. Things are doing good. Everyone thinks the Fed can handle this, Dimon said. The hurricane is right out there, down the road. It's coming our way. There are two main factors that Dimon's worried about. First, the Federal Reserve has signaled it will reverse its emergency bond buying programs and shrink its balance sheet. The so-called quantitative tightening, or QT, is scheduled to begin this month. It's actually today, the first day, June 1st. It would ramp up to $95 billion a month and reduce bond holdings. We've never seen QT like this, so if you're looking at something you could be writing history books on over the next 50 years, Dimon said. Several aspects of quantitative easing programs backfired, including negative rates, which he called a huge mistake. Central banks don't have the choice because there's too much liquidity in the system, Dimon said, referring to the tightening actions. They have to remove some of the liquidity to stop the speculation, reduce home prices, and stuff like that. So what they're going to do as this begins to really happen, I believe, is bring a lot more fear into the housing market. How I see this all kind of playing out in the short term is as rates go up and more fear sets in, people that are thinking about selling their homes over the next 1 year, 2 year, 3 year period, they're going to start saying, you know what, this is probably going to be the best I'm going to be able to do. I should have probably sold 6 months ago, but I didn't, but I want to try to get out now. And we're going to have sellers all across the country thinking the same exact thing. We need to exit now. And what's ultimately going to happen is there's going to be even more supply than available demand. And as that happens, as rates continue to soar, and as we start to see people lose their net worth, whether it be through stocks being reevaluated or their 401ks, pensions, inflation, all these new problems starting to step in, there's going to be more uncertainty. And with that, there's going to be more hesitancy for people to step in and buy properties as people, wait to see what actually happens. What I also think is going to happen is banks are going to stop lending money at the same velocity that they have in the past. As what he says right here, he says the other factor worrying Dimon is that the Ukraine situation and an impact on commodities, including food and fuel. Oil almost has to go up in price because of disruptions caused by the worst economic conflict since World War II, potentially hitting $150, $175 a barrel. So right now we're like at about 120, and we got a long way to go. We've even heard a forecast above 200. So wars go bad if they go bad in the South and unintended consequences, Dimon said. We're not talking about proper actions to protect Europe from what is going to happen. Last week, during an investor conference for his bank, Dimon referred to his economic concerns in storm clouds that could dissipate. Presentations from Dimon and his deputies at the all-day meeting have bolstered JP Morgan shares by giving greater detail on investments, updated figures on interest revenue, but his concerns seem to have deepened since then. During the response to the 2008 financial crisis, central banks, commercial banks, and foreign exchange trading firms were the three major buyers of U.S. Treasuries. The players won't have the capacity or desire to soak up as many bonds this time. That's huge change in the flow of funds around the world. I don't know what the effect of that is going to be, but I'm prepared for at a minimum huge volatility. One step the bank could take to grid itself for a coming hurricane is to push clients to move a type of lower quality deposit called non-operation deposits in other places, such as money market funds, for example, that would help the bank manage its capital requirements under international rules, potentially helping it absorb a surge in bad loans. You think about what he's saying there. He's telling people to put money, non-operational deposits, to help the banks absorb a bunch of bad loans, right? Because you have these people over the last couple of years that have purchased properties, traditional debt to income ratio is about 26%. Meaning, if you're making 10 grand a month, you're spending $2,600 in your house payment. Well, now it's at 31%. So, we got a 5% increase, which is pretty substantial, about 18%. And what we're also seeing on top of that is we are seeing this inflation problem, and we're seeing wealth get sucked away. So many people thought they were a lot wealthier than they were because stocks were just like a rocket ship straight to the moon. But as it starts to pull back, we're going to really, really start to see how many people can actually hold on to these properties that they acquired over the last few years. With all this capital uncertainty, we're going to have to take actions, Dimon said. I kind of want to shed non-operating deposits again, which we can do in this size to protect ourselves so we can serve our clients in bad times. That's the environment we are dealing with. Banks have a fortress balance sheet, and conservative accountings are the best protections for a downturn. The banks has shield away from servicing a lot of federal FHA loans, he said, because of delinquencies could hit 5% or 10% there, which is guaranteed to happen in a downturn. Dimon went on tearing during the hour-long session, barreling through topics like greatest hits, his observations and gripes, often letting loose with profanity. He lambasted investors for voting alongside with proxy advisors of Glass Lewis, which has disagreed with JP Morgan on recent matters, including executive compensation, right? Shame on you, that's how you vote. Companies are being driven out of public markets because of litigation, regulation, press, cookie-cutter governance. Meanwhile, other critics often conflate stakeholder capitalism for being woke. Red-blooded, free market capitalism. Yeah. So what we are going to see is a lot of uncertainty, a hell of a lot of uncertainty in these markets going forward. It's pretty crazy to me to really kind of look at the economy, look at what's happened over the last couple of years. If I first had gotten into business early in like 2007, 2008, when I was like working for myself and like in the real estate space. And back then there was real fear. People were concerned about what tomorrow was going to look like. Over the last couple of years, we didn't see that fear. Everyone just thought tomorrow was just going to be a couple of percentage points higher than today. And there's no real, risk assessment. So when we have this type of outlook, it's going to be interesting to see how people behave and how, a lot of people don't remember what 2008, 2010 looked like because a lot of people are too young. But when we start to step back in these times, we're going to start to see a lot of hard lessons learned. What do you think about this entire situation? Do you think we're stepping into a hurricane? I think we're going to be stepping into a depression, a real recession that's going to lead into a depression. I think it's going to be really bad. I'm a very optimistic guy, and I've always have been very optimistic, but I'm also realistic. I understand what's actually happening in the economy, where we're all headed as a society, and what we should all be doing to prepare ourselves for this. I believe, an online business, multiple streams of revenue, if you're going to have debt, make sure it's fixed rate debt, being responsible, really coming out with a strong game plan. Because when things really hit the fan, you're going to want to make sure you're in a position to, advance rather than, just trying to hold on. What do you think about all this? Drop your comments below, hit the like button, subscribe now, and also subscribe to my second YouTube channel. It's a podcast, an interactive show starting next week, or excuse me, probably Friday. Waiting for a couple of things to come in from Amazon, but when I get everything, it's going to be a really cool interactive show. And then LinkedIn, Twitter, TikTok, everything's in the banner. I'll catch you guys later.